Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. I was going through some articles and I like to share articles with everyone and I give my comments. So I put some article headlines together and a little bit of some blurbs or excerpts from the articles, and I'll read through them. And a lot of them I'm going to keep it pretty high level and just kind of go over the high level stuff here and discuss it. It says U.S. natural gas prices climb most ever in a single day. The U.S. natural gas futures surged 72% just ahead of expiration of the February contract. The huge spike in the February contract is a clear sign that bearish bets were being squeezed out of the market. Cold weather in many parts of the United States have boosted demand for the energy commodity, and I am very heavily positioned in natural gas companies like SM Energy, CDEV, which is Centennial Resource Development, CDEV. We've got Comstock Resources. We've got Sandridge Energy. We've got Crew Energy. We've got a whole bunch of natural gas producers, Southwestern Energy, Antero Resources. My guess of 2022 was that natural gas was going to go up the most of any commodity. That's my guess for 2022. We've seen these natural gas spikes happen in Asia, happen in Europe. I don't see how it's just going to skip over us. The signs that I'm looking at is we are using more energy and we are depending more on natural gas from renewables, basically not producing. So we put these unreliable sources in of energy, the gathering systems of these energy systems, and we're relying on the swing producer of natural gas. But if they're not producing, what you're doing is you're burning more and more natural gas. Your demand is greatly increasing of natural gas, and it's a very volatile demand because sometimes you use it, sometimes you don't. It's very unpredictable. So we're eating through inventories. We also use natural gas to heat our houses. So I think in the winter is when we're going to see these massive spikes, is when the renewables aren't pumping the electricity. We run the natural gas overtime. We get cold weather, and it's like we don't have the inventories to really soak up that high of demand as our demand for natural gas grows exponentially. So that's that part. We've got low carbon energy investment must triple to reach net zero target. And that says the world invested a record $755 billion in the energy transition in 2021. Total investment in low carbon energy must triple to put the world on track for net zero emissions in 2050. So BNEF states investment needs to triple to average 2.1 trillion a year in 2022 to 2025. And then it needs to double again to an average of 4.2 trillion between 2026 and 2030. They're pumping a whole bunch of money into low carbon energy investments. Now, my take on this, and I know the money is going there, all this ESG and all this stuff, and it's going to raise the cost of getting minerals out of the ground. So those figures are probably off by 50% or more. So you may have to go way higher than what that is. Because as we put more and more constraints on the world, and if these things aren't economically viable, the very thing that sustained life and grew life in this world is going to become a lot less affordable. And that means that the population will have to decline if this isn't affordable. So you have that type of scenario where, do we want to have unaffordable energy costs, which will drastically harm humankind, or do we go back to burning fossil fuels? Because I don't know if the renewables are cheap enough, reliable enough, stable enough, robust enough to run an entire system and economy on it. We don't have the buffering in the system for things that generate electricity that you can't store. We just don't have that system yet. So that's kind of my opinion there. We've got higher oil prices could trigger a $500 billion in stranded assets. So one thing I wanted to touch on here, and I'm trying to connect all this stuff together, is we've got these ESG mandates, and there's a whole bunch of companies that are investing directly into ESG. That's environmental, social, governance standards or something like that, where people are, well, they think are flowing money into something that is sustainable. And what that's doing is it's drawing capital or preventing capital, as much capital, to move to fossil fuel type investments. If the ESG movement fails, what happens is you're also going to fail massively on the fossil fuel side because the money hasn't been flowing into it. So what's happening, and what this article is saying, is that higher oil prices could trigger a $500 billion. It says oil companies could get caught in a stranded asset trap worth $500 billion. Surging oil prices may tempt oil and gas companies to make long-term investment decisions that cost shareholders dearly. And you're saying, well, why would that happen? It says, according to the report, surging oil prices may tempt oil and gas companies to make long-term investment decisions that cost shareholders dearly. But a cautious, managed approach to the energy transition would do most to preserve shareholder value and help society achieve climate goals. And I'm not so worried about the wording that they put. The wording and the thinking that I'm going to put in there is people in the fossil fuel companies are very reluctant to dump a lot of money and take on loans to dump into production because they think that it's possible that the world is going to try to move away from fossil fuels. The money's not going to be there, and their investments that they put in for a 20-year investment, let's say, may not be valuable 10 years from now if they were to really gain traction in the electric vehicle movement and the ESG movement and the renewable movement. So whether they're right or wrong, now you're basically, it becomes a very complex investment environment for those of fossil fuels. But if fossil fuels are cheaper and they are, what we'll call it, are not just cheaper, but more robust, more reliable, and a better solution for a complex society, we have to invest in it. Because if the renewables don't work, what is that going to leave us with in society? A society that doesn't work? A society that's starved of energy? A society that we're literally starving for food? I mean, who wants to live in that? And I don't, that may not be the case. Maybe it doesn't work like that. Maybe it does. I don't know. But I don't want to see an energy-starved society. And I'm going to read a couple of things here. It says, the authors noted that a recent surge in oil prices, but cautioned big oil about letting it go to their heads because climate commitments made by governments and the assumed wider adoption of EVs will soon reverse the oil demand growth trend. That's what they think. And at the same time, the mining and commodity industries are warning of rising prices for metals and minerals, both essential for solar, wind, and electric cars. At the recent Future Minerals Forum in Saudi Arabia, for instance, Barrick's CEO projected that the copper market could swing into a shortage. Strategists in principle said that metals and mineral prices are on a stable upward trajectory, and they're not coming back. They're not coming back down, is what he's saying. The rising costs of raw materials have already begun to affect the renewable energy and EV industry, making their products costlier and reducing the number of people willing to switch to a low-carbon alternative to fossil fuels. It also jeopardized the progress of the energy transition, according to analysts, raising the price tag substantially of these renewables and EVs. So even so, according to the lead author of the Carbon Tracker report, companies may see high prices as a huge neon sign pointing towards investment in more supply. However, this could become a nightmare scenario if they go ahead with projects which deliver oil around the time that demand starts to decline. Shareholders could face catastrophic levels of value destruction as prices fall. And that's what the current paradigm is of a lot of these large companies and making big long-term investments in some of these fossil fuels. And then you've got the tax implications too, and the carbon credits and all this other stuff that's baggage attached to it. So they have a very it's a very weird environment. And I think that environment's going to last however long inflation lasts, because their input costs are going to be driven to astronomical levels of those renewables, because they're all mineral dense solutions. And on the other side, the alternative, the fossil fuels, they don't want to invest in it either. So if plan A doesn't work on the renewables because of increased raw material costs or just flat out shortages of the materials that you have, and you're not investing in the oil and natural gas side of things, then what are we left with? I mean, we're setting ourselves up for the largest squeeze, I think, in fossil fuels that we'll ever see in anyone's lifetime. And if the renewables, if let's say we partially get down this road, if the renewables are not performing the way we want them to, or we hit limitations on the renewable side, what we're going to do is whatever we have in the system that we can flip back on, I think they're going to flip it back on. That can be coal, it can be nuclear, it can be whatever. Because I wouldn't think that the people who who get voted into power, I don't think people would vote for these people again if they're literally starved of energy. So I think they would say, I don't care about the ESG mandates or the environment, flip back on energy and just in general. It doesn't matter what the source is. That's kind of how I'm thinking about it. Maybe they won't. Maybe they're all cool with, freezing in the winter, but that's whatever. We've got the era of cheap renewables grinds to a halt. Raw material shortages, notably in metals and minerals and polysilicon, are impacting the renewable energy industry. The cost of solar panels, wind turbines, and EV batteries is climbing after years of declines, and that's because of a commodity disinflationary period versus an inflationary period. Solar panel prices had surged by more than 50% in the past 12 months alone. The price of wind turbines is up 13%. Battery prices are rising for the first time ever. So the solar price has gone up quite dramatically based off of their input costs and maybe their energy costs to produce. And I was reading this. It says, what is holding the solar boom back? It says solar power is lagging behind wind power in America's energy mix. The reason renewables and solar in particular have struggled to gain ground is due to an uneven history of governmental support. President Biden has said that he intends to put the United States on track to have a completely clean powered grid within the next 50 years. And I would disagree with that statement. What is holding the solar boom back is that it's not economically feasible to implement it. Because if it was cheaper to do solar, everyone would do it. All of these companies would do it. Why wouldn't they? If that was a superior generation source or gathering system, superior gathering system of light, which gathers energy for society, and it was cheaper than everything else, then why doesn't everyone do it? Why would the government have to come in and support it? It must not be superior if the government has to subsidize it or support it. Therefore, the market, it's probably not a good solution for the market at this time. We're going to have to find something better. So to sum all of this stuff up, to sum it all up, we've got a natural gas price squeeze that's happening in America right now. And we've seen our largest single day ever of a 72% increase. They are dumping money, massive amounts of money, and we're going to have to dump way more money into this low carbon energy investment world. People are afraid to invest into the assets of fossil fuels, oil, natural gas, coal, whatever it may be, because the amounts of money and the regulations and all the things that are going into ESG renewables and electric vehicles could strand the assets that those people have invested in. And what's happening is that money and those investments going into renewables, the renewables prices are rocketing higher because we're starting to go into an inflationary environment. those market conditions that should last for the next 10 years plus is going to be a headwind for those renewables. And the renewables may price themselves out of the market or will hit shortages of certain things in those markets that will prevent them from building the renewables, irrespective of how much money chases it. If that's the case, we end up with the largest squeeze in fossil fuels for the next decade, based off of declining investment in fossil fuels and solution A, the renewables, which could run into mineral shortages and far higher prices of the minerals being extracted out of the ground, their input costs. So it's a very good, I think, environment for something that's maybe in the middle, like a uranium, which meets all the ESG requirements. It meets the high energy return on investment. It meets the low mineral density inputs that we can build. It consolidates and reduces the power lines that we have to run to it versus the renewables. So something like fossil fuels, oil, natural gas, and uranium, I think, are going to be incredible bets over the next 10, 15 years. So that's my take on it. If you guys like the analysis, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.